It's a classic breakout on the market. Here's what you need to know before the bell. On Friday, markets closed right at the previous peak. This morning, futures are pointing dramatically higher on really news of both a debt ceiling deal and more talk from NVDIA about the AI revolution and what that means for the world. Basically, anybody will be able to program computers simply by talking to them. It's a pretty amazing thing here. This morning, though, that's boosting the markets. NASDAQ up right now about 195 points. S&P's up about 25. So again, it's going to be a pretty strong start out of the gate this morning. Technology clearly leading the way here. As we talk about in today's blog post on the website, the AI revolution fully in swing here on our technical market update today, talking about what that trend looks like, what that means for the markets, and where potentially markets can move to from here. So again, this is a classic breakout. Last week, we had a breakout, a sell-off that retested support, and now a new high today. This is a classic breakout structure of this consolidation range that we've been in for the last 45 days. Now, importantly, we're still on a buy signal here, and the markets are not extremely overbought just yet. And once we start looking back here over the last really 2 years and looking back at where we were in January of 2022, what we see here is that this breakout is now going to take out these supports that the markets had when Russia invaded Ukraine back in January, February of 2022. This now sets the market up for a rally towards these March highs that we had, and that's going to really start to set the stage here for this return to the market back to all-time highs. Now, it's not going to happen overnight, by the way, but once we kind of clear out of this consolidation range that we've been in, and we start to clear this resistance level that we've got back at these January 22 lows, that really only sets these March highs as the next run. So again, now that we've completed a 50% retracement from the lows of the markets last October, the next real steps are 61.8% Fibonacci retracement. That gets us right around to 4,400. And then after that, it's basically going to be a setup to get us back to 4,600 by the end of this year. Again, that's just technically what's going on in the markets. There's certainly a lot of things can happen, but we kind of keep getting over these hurdles, right? We keep worrying about all these events that are going to occur, the Fed rate hikes or the debt ceiling limit, and the market kind of keeps climbing that wall of worry. And since we have so much bearishness still in the markets, that's providing this fuel for this rally. So again, this rally can likely go on for a lot longer than you expect. We have to participate with it the best we can, but we need to remain cautious here because, again, there are certainly concerns, both economically as well as financially in the markets. Valuations are still a risk. Earnings are recovering, but will they recover as fast as what markets are expecting? Those are the risks that are out there. Certainly not denying that. Right now, the markets are performing more bullishly, so we need to participate with the markets, but we need to do so with just a little bit of risk controls as well. That's what's happening in the markets this morning. I'm your host, Lance Roberts, and that's what you need to know before the bell.